Okay, so financial reporting challenges. So in this section, we're looking at the financial reporting challenges of voluntary contributions, whether that is of cash, assets, or time, whether it's grant receipts or any kind of revenue that is received by an NPO that is not the sale of a good or service. We're also looking at the financial reporting challenges where a contribution is received of inventory items. So let's turn to these financial reporting challenges. We are highlighting recognition, measurement and disclosure as the most significant financial reporting for both of these issues. And so if you go back to kind of and look at the International Accounting Standards Board framework for financial reporting, income is defined at its core as being an increase in assets. And by definition, assets must be controlled by an entity. So to recognise revenue, we're concerned with issues like when are revenues controlled by an NPO, because that is the first sort of condition, if you like, that needs to be satisfied to be able to recognise revenue. So recognition issues will also include things like the timing perspective in terms of when they should be included in the financial statements. We're also concerned with whether it's possible to get a reliable measurement of an asset, so it's possible to recognise values for donations, including inventory. In terms of measurement, we're concerned with how to determine the value of the resources that have been provided, particularly non-cash resources, where it might be difficult to determine a value. And then in terms of disclosure, we're interested in whether there's any information that should be disclosed in the financial statements that will help it make it easier for readers to understand the information in the financial statements. So in these aspects of recognition, measurement and disclosure, these lie at the heart of the challenges discussed in the consultation paper. And we'll now look at each of these in turn. So the first issue to consider is whether the NPO controls the resources that have been provided to it. And you might wonder why we are starting with control, but the reason for this is that if an NPO does not control an asset, basically it doesn't have to worry about whether it's got to recognise it or measure it. So it is absolutely the first consideration. And the first step will be for NPOs to determine if they control the cash or other resources that have been provided to it. This may seem straightforward, particularly for cash contributions, but if a contributor provides an asset for an NPO to use for a project, but requires it to be returned at some point, is that donation of an asset that has been made kind of in perpetuity, that the asset that the NPO controls, a gift in kind, or is it the right to use an asset for a period, which might be a service in kind, where the NPO only controls it for the period that it uses it? There are also issues specifically related to services in kind, because NPOs can recognise revenue in respect of services in kind where there is a past event and an NPO expects to get a future benefit from those services, which will enable it to further its objectives. But this is in line with the definition of assets in the IASB's conceptual framework, and it applies even if that future benefit is used straight away, like professional services. So you could, a controlled service then would be one where, say, a professional service has been provided in the past, and the NPO is exercising some control over that work is being done. So only those that are under the control of an NPO can be recognised. And if I give an example here, if an individual provides an accountancy services, for example, to review an NPO's accounts, this is likely to be under the control of the NPO if they're scoping the work to be done and have records to support this. But if I can contrast this with, let's say, a group of individuals who voluntarily decide to hold a coffee morning to raise funds, the time of the people that are providing a service in kind by organising the event is not likely to be under the direction of the NPO and is less likely to be under the control of the MPO, and so less likely to be recorded. I think this sounds right. The less likely the MPO to have control over the activities, the less likely is to have records. I think that goes together. So MPOs need to have records and processes to demonstrate that they have control over the delivery of services in kind, or the outputs of the services in kind. The question of control also arises if a contribution is made through a pledge, but the pledge is not binding on the donor. In other words, the donor could change its mind from the point in time that the pledge is made. In this situation, the MPO is not likely to control that asset, and control will pass at a later point in time, and most likely when the asset has been received, actually, in this case. But the MPO will need to have appropriate monitoring processes, as it will have an impact on when the revenue can be recognised. This also applies to bequests, but we're going to be looking at that as a separate topic at a later stage of this project. So you can see in these kinds of situations, ascertaining control over resources that are being provided might be challenging. For some types of resource, like services in kind, an MPO may need additional systems to ascertain the amount of resource it controls. And with MPOs needing to be certain that they have control over resources that have been provided to them to be recognised, additional records and systems might come at a disproportionate cost. Having determined whether an MPO controls an asset, it will then need to ascertain if it can obtain a reliable measurement of the value of the resources that have been donated or contributed. If it's cash, that's probably fairly straightforward, but less so if the contribution is of an asset or service. An MPO will not be able to recognise any revenue as a result of receiving the donated item if it can't obtain a reliable measurement. And for an MPO to be able to reliably measure non-current contributed assets, it needs to determine their fair value. With fair value sorry, I can't get my words out. Fair value becomes the deemed cost of the items that have been contributed, because you don't know actually what they cost. And to determine fair value, an MPO needs to know the date that it took control of the item and can estimate its value at that date. If an MPO cannot obtain a reliable measurement, it cannot recognise the item as an asset or inventory in its balance sheet, or at least it can't until it's able to measure it. In addition to this point, it can be difficult to reliably measure a service in kind, such as assigning a value to volunteers' time. You know, volunteers who donate their time for general activities that don't require specialist qualifications or skills may be particularly difficult to measure, because it may be difficult to capture both the hours of time that's been spent and the value for the services. Specific activities that relate to professional service may be easier to capture, and from this it might be possible to determine a reliable measurement. For an MPO to measure the value of a gift in kind, it needs to know also the date that it took control of it, and similarly be able to estimate its value at that date. But practically it may be difficult to obtain a reliable measurement because of the nature of the item that has been donated. We'll talk a bit more about that later. But as in determining control, the cost of obtaining a reliable value may be disproportionate to its value and outweigh the benefits that measurement could provide. So some contributions in kind are, for accounting purposes, treated as inventory, like the emergency items that Philip mentioned earlier in his video. And where such contributions can be reliably measured, they are normally recognised as assets in the balance sheet and initially measured at cost. Well, a bit more on this in a minute. But if a reliable measurement cannot be obtained, then no asset is recognised. And this means that neither the revenue nor the asset will be recorded at the point of receipt. It also means that when inventory is used, this may not be recorded in the financial statements either by way of expense. So a lack of reliable measurement may mean that inventory items are not transparent in the financial statements. So I promised a bit more on recognising inventory. So when an MPO acquires inventory by purchasing the inventory itself, the cost of inventory should be pretty straightforward to determine. And while there may be challenges in determining the cost of own produced inventory, these issues are not likely to be unique to MPOs and will be similar to any other kind of entity that needs to produce those kinds of valuations. But while there are no issues that are unique to MPOs for purchase inventory, there are issues for low value, high volume inventory and inventory that is held for onward distribution. For low value, high volume items that are given for resale, such as items donated to raise funds through, say, a shop, it may be impractical for an MPO to determine a reliable estimate. For these types of items, MPOs may not have suitable inventory recording systems or management systems to record the inventory that they have. And if it is impractical to determine a reliable estimate of the value, no revenue would be recognised at the point that the donated items have been received. However, revenue can be recognised at a later point when the items are sold, and there's certainty then about the value. So rather than revenue being recognised when a gift is received, it would be recognised when the gift is sold on. So at that point, a reliable estimate can be made. So that's one aspect of inventory, which is the low value, high volume stuff. But we talked as well about issues about inventory held for onward distribution. And it may be difficult to prepare a reliable estimate for this kind of inventory, even if the value of each item is known. This may sound strange, but some items may have a value when donated, but have a zero value if they cannot be used by the MPO. So if an MPO receives the gifts of vaccinations, for example, if those vaccinations have to be consumed within a defined period because they're close to an expiry date, and the MPO is not certain that those vaccinations can be used because it's a short time to use them, they won't know whether those donated vaccinations have a value or not, or it may be difficult to determine what value they have. And these practical difficulties that arise have, can have a real impact on trying to determine the value of the items. So if the value of individual items is known, revenue and a corresponding expense could be recognised when the item of inventory is used. And this would provide useful information about the cost of the MPO's activities. However, if there are no proceeds from the onward distribution, which is typically the case because they're being provided as part of the service, it's possible that as well as not recognising the revenue on receipt of the donated item, revenue might not also be recognised subsequently because the sale value is zero. And so this means that donated inventory that cannot be reliably measured might not appear anywhere in the financial statements. And as a consequence, it's possible that revenue is never recognised for items that are held for onward distribution. And it might be that to be transparent, disclosures would be needed. And we'll talk a bit more about disclosures very shortly. We've talked a fair bit about volunteering already, but I just wanted to go into just a bit more detail on this particular area. And I think, as we've said, volunteering can take multiple forms. It can be general activities like digging holes for planting of trees, or spending time with the elderly or vulnerable people to provide them with companionship. Or it can be professional services where a specific skill is being utilised, such as an architect or a doctor, accountant, engineer or teacher, to name a few. Typically, for the services that have got a kind of more a professional element to them, this type of service might otherwise have been paid for if a volunteer hadn't donated their time. So in the accounting example I gave earlier, if someone hadn't donated time to review an NPO's accounts, the NPO might have had to pay somebody to do that. And so there is, if you like, a value that can come from that. Services in kind can also be provided for the construction of assets. For example, an architect could be used to design a building. And if this service was being provided under a fee arrangement, the cost of these services would be known and included in the cost of the asset. So where assets are being constructed, the value of these services in kind should arguably be included so that the full cost of the asset is understood and is comparable with other assets either held by the NPO or with comparable organisations. So I think, as we've kind of touched on before, some volunteers may provide their time under the direction of the NPO and others independently or semi-independently of the NPO. And if volunteers are providing time under direction of an NPO, the NPO may have records that capture the amount of time donated it, who provided it, and when they provided it, and what they were doing. However, other volunteering activities may be less easily captured by an NPO. So as noted under the slides where we talked about control and reliable measurement, record keeping may present a challenge. Given the nature of these contributions, NPOs that receive services in kind and recognise revenue will usually consume the benefits of those services immediately. And this would also lead to an expense and revenue being recognised when the services are received. This reflects both the service being donated and the use of that service being provided. So if I was providing my services as an accountant to an NPO free of charge, the NPO would recognise as a revenue the donation of my time, but it was also would show as an expense that what the donation had been spent on, which could be, let's say, financial consultancy. The key point is that revenue and associated consumption of the contribution can only be recorded if the information can be captured and reliably measured. I want to turn now to stipulations, which I think a number of you identified as an issue when we did the last poll. And it can be a challenge to decide in which reporting period revenue should be recognised because contributions and grants come with stipulations. And these stipulations may be conditions that have to be satisfied or restrictions that limit how resources can be used by an NPO. And so we're going to look at first conditions and then move on to restrictions. So conditions can be set by the individual providing resources or the organisation providing the resources. And we heard about some of these earlier in the video. I think Sam gave an example about hospital beds for non-paying patients in India, and providing these hospital beds was a condition of getting a grant from government. So setting conditions means that certain activities must be performed by the NPO before it is entitled to the resource. And that is the case whether it is a contribution or a grant. And these conditions are likely to be set out in some form of agreement or documentation that sets out the arrangements between the contributor and the NPO. And since the NPO is only entitled to the revenue once conditions have been met, revenue can only be recognised once any substantive performance requirements have been satisfied. And when I talk about substantive performance requirement, these are the requirements that are most important and central to the arrangement between the NPO and the contributor. And judgment may be required to determine whether those performance requirements have been met. If they haven't been met, revenue may need to be deferred until they are. So the substance of the conditions that have been imposed need to be considered, not just that their legal form or the form that's in the document. And that means that the intention or the purpose of the conditions needs to be understood from the agreement, and means that identifying the performance requirements or conditions and determining how are they going to affect the recognition of the NPO's revenue. And this can be a challenge. So judgments may be needed about the chances of having also to refund revenue. So if conditions are not met, for example, and judgments may need to be made about whether there is a likelihood of giving a refund and whether that is more likely or not. And of course, that judgment may change over time. And so that assessment needs to be at regular intervals. And these judgments need to also be quantified to determine whether there is a liability arising from these arrangements. And so you can then determine the value of the liability, because if a refund needs to be given, then you may owe some money back and need to recognise that. And the value of that liability would represent an NPO's obligation to undertake the activities necessary to meet the conditions if the stipulation specifies a return of equal value or to reserve the resources to the contributor or grantor. In some instances, contributions or grants are paid in arrears, with the cash transfer only falling due once conditions have been met, whether that's in full or in part. So NPOs therefore need to determine how much revenue to recognise when they haven't yet had the money. NPOs with an expected entitlement will need to determine the amount of revenue to recognise and a corresponding debtor for the cash they're yet to receive. So again, judgments may be required about the extent to which conditions attached to the agreements have been met, so that the NPO can estimate that amount of revenue. So in addition to conditions, I think, as we said, NPOs can also receive contributions with restrictions. And this is a different kind of stipulation. A restriction requires that a contribution or grant is applied to a specific purpose. And this purpose may be operational in nature. For example, the restriction may require that the contribution can only be applied, let's say, to educational purposes, or it could be for new assets. For example, the contribution can only be spent on building a new hospital ward. But there are not specific conditions in the same way that I described earlier. So guidance may be required on materiality when assessing and helping to form judgments, as well as considering the costs against the benefits of tracking contributions with stipulations attached to them. This can be a very complex area. I mentioned asset construction when I talked about volunteer services. But just to follow that up a bit further, I mean, stipulations can also be attached to cash given for the construction of assets. And this can give rise to specific financial reporting challenges too, particularly if the capital asset can only be used for a specific purpose. The requirement to use a capital asset as intended may be set for a period or be open-ended. And the terms in these types of arrangements may be considered a performance requirement, in other words, a condition on the use of the asset, with revenue deferred until the risk of repayment has reduced. Alternatively, it can be considered a restriction on the use of the asset, with revenue recognised immediately, but any subsequent change in use would trigger repayment as a separate event. So if the asset use restriction is considered a performance requirement, there may also be a challenge in understanding when a condition is met. Would it be over the period that the asset is constructed or acquired, or over the lifetime of the assets? This also can be complex. Turning to measurements now, measuring services or assets that have been gifted can be problematic. Less so, of course, with cash, but assigning a value can be challenging where the donations take the form of gifts in kind or services in kind, as we've talked about under reliable measurement. And there are more significant challenges in measuring the cost of donated items, as there is no purchase cost. Instead, the fair value of the items is used as their deemed cost is when being recognised. We discussed earlier some of these issues in the context of reliable measurement, as I've said, and particularly relating to inventory. But determining the value of donated capital assets, both tangible and intangible, may be equally challenging and impact the amount of revenue recognised. So, for example, if housing is donated to an NPO for social purposes, but could be sold at a higher price for commercial development, it might be argued that the social housing is measured to reflect the value as commercial development land. But this might not appropriately reflect the nature of an NPO's objectives or the service potential that it might be deriving from the asset. And we discussed earlier some of the challenges relating to volunteer time in the example I gave about, contribution of my time and how that might be measured. But just to bring that to life, for example, if I'm measuring my time, should it be measured by using the rate I earn in the market in which I operate in Northern Ireland? Should it be measured by the rate that NPOs generally pay in my jurisdiction? Or should it be measured at a rate paid in the jurisdiction where I'm providing the services, or perhaps some other benchmark? So the ability to measure the services provided could be impacted by knowing what value to place on the time being provided. Services provided on a commercial basis may be more easily measured than other services, as market prices might exist. And where a service would have been purchased if it hadn't been donated, it might be more easily measured. And there is a stronger argument for recognition. But assessing the fair value of the items may impose costs or administrative burdens on some NPOs, with the cost of assessing value being potentially disproportionate to the value of the item and exceed the benefits derived from being able to recognise the items. We discussed earlier the challenges of keeping appropriate inventory records, particularly if an NPO doesn't have inventory control systems. So there are some challenges there. But even after an asset is initially received, its value might change over time, and there is a need to subsequently measure the assets. And determining subsequent values for types of inventory may be challenging. Under international frameworks, inventory is subsequently measured to ensure that its carrying value does not exceed the value that can be obtained from the inventory. And if the contribution of inventory items was not initially recognised as inventory in balance sheet, then clearly there's no issues of subsequent measure because they weren't recorded. But it's still important that those items are monitored. Inventory will need to be written down or impaired where the carrying amount of the inventory exceeds its value to the NPO. Impairing inventory relies on being able to determine the value to the NPO. And this might create a financial reporting challenge because it may be difficult to determine and evidence an appropriate value, particularly when considering the value to the NPO of the inventory and service delivery rather than a sale value for it. And there's also the question of whether or how to account for donations that are not suitable for resale. If these have been recognised as inventory, it may be necessary to impair the items if it's subsequently determined that they can't be sold or used by the NPO. So when we were talking about vaccinations earlier, an NPO could decide to put some value on it, but if it can't use them, it might have to impair them or write them off. And finally, I want to move on to disclosure. So categorization of revenue is important, particularly if there are different accounting treatments for different types of revenue. Standardizing the presentation of revenue in the financial statements can assist the understanding of sources of funding for an NPO, because as we've seen, not all revenue can be freely deployed by an NPO, particularly if it has limitations attached to it. So it could be useful to identify that revenue that has been recognised immediately because you've got the cash, but is subject to the kinds of restrictions that we've talked about. And so stakeholders might benefit from increased standardisation to access the information they need to understand the extent to which revenue can be used to generally fund an NPO's expenditure or the extent to which it's restricted. So additional disclosures may be helpful in providing transparency and to ensure that stakeholders have an accurate picture of the NPO's financial position and dependencies. For example, an NPO could be highly dependent on volunteers to deliver its services, and disclosing material amounts or activities that are fundamental to the operations of the NPO could be useful in understanding that. And this would provide visibility of the nature, amount, timing and uncertainty of revenue, as well as disclosures that could talk about revenue that isn't recognised in the financial statements yet because conditions haven't been met. And all of those things can help understanding of stakeholders. So far in this webinar, we've been talking exclusively about non-exchange transactions. And in the consultation paper, we describe non-exchange transactions as revenue that is received by an NPO, where the NPO doesn't have to provide something of approximate equal value in return directly to the person that's provided it. The benefit goes to a third party. But in practice, we know that there may be transactions that are partly exchange and partly non-exchange. I think in the poll that results we saw earlier, that wasn't a major concern for participants in this webinar, but we're aware that it can arise. And in this consultation paper, we are only looking at non-exchange revenue. So if there are exchange elements to the revenue that you receive, it would be good to hear about those kinds of things. And particularly challenges about how allocating that revenue between exchange and non-exchange may be a challenge or may be onerous, and the issues involved in that. We note that additional disclosures can lead to additional cost. And again, as we've talked about before, the cost of preparing additional disclosures might be disproportionate to the benefit that comes from that. And we also recognise that some NPOs may not have resources to provide information. So there's a balance to be held on that.